Hey everyone, welcome to this week's episode of the Swyftx Squawk. I'm Pav, lead market analyst here at Swyftx, and this week we're going to do something a little bit different. Markets, while we are starting to see things heat up into the back end of the week, all in all, the last, let's call it 10 to 20 days, Bitcoin's been range bound. Some alts have shown outperformance, but all in all, it seems like even markets, broadly speaking, are in almost like a bit of a holding pattern. And I wanted to take today to really do something a little bit out of the box and try to provide a little bit more value to you, the listener, and really unpack what we're seeing play out in the broader macro, what is happening on the broader scale that's caused a little of this trepidation in the last 7 days. It really has been triggered as of last week, which I'm going to dive into. But I just want to start off and say, don't be too afraid of this. It obviously is going to be maybe a little bit out of everyone's comfort zone in terms of information. But if you're really trying to understand what comes next, I feel like this is an episode you're going to want to stick around for. So let's crack in. So really where it all starts and finishes is with the Fed. So in the US, the Federal Open Markets Committee, or FOMC as it's regularly referred to, is this independent body that sets the monetary policy for the US economy. So it's agnostic from the government. They're not related. Obviously, the two influence each other. But at the end of the day, it has two mandates: to basically protect growth and employment in the US, but also to curb inflation. Now, this is really important when we talk about interest rates, which obviously have been at highs in the last 2 to 3 years as we've come out of that post-COVID era. And right now, we're seeing many countries, except for the US, really start to bring those interest rates down. And that's where the tension is simmering and boiling. And again, when we're trying to understand what the market's doing today versus yesterday and what it might be doing tomorrow, it's all about expectations versus reality. Are the expectations of what the market's expecting meeting what the policymakers are foreseeing as well? Is there a discrepancy? Is there some sort of arbitrage there? And that's what I'm really going to try to articulate for everyone here today. So at the end of the day, we know for a fact that the Fed came out last week and Jerome Powell basically said that as a consensus, there was some amount of disdain, which is quite unique for this committee. Usually they're singing from the same hymn sheet. So again, it just shows you that even within their own confines there is this sort of tension. They're not sure themselves what to do right now, is what you can take away from that. They held rates steady. And the key talking point that Jerome Powell, really the chair of this federal committee, really stood back and stood tall on was inflation and growth. He basically said, number one, we're still concerned about inflation, again, pointing to the whole issues around tariffs. But number two, they're not seeing growth really waver. And we saw that last week as well, which was a big week for data releases. GDP data, or gross domestic product, or the productivity of an economy, came in above expectations in the US. And that's what led to this particular line from Jerome Powell that may have caught a lot of the market off guard and maybe even landed a bit of a haymaker. It seems to me, and almost the whole committee, that the economy is not performing as though a restrictive policy is holding it back inappropriately. Now, very short, very sharp, but at the end of the day, if this whole idea that, hey, look, we've been tightening the economy, we've really been saving and scrimping away every dollar, we're not being over accommodative, not providing too much money to the system, which is what we saw during COVID, when the market's still growing. And that's the balance that the Fed's really looking for. But this isn't the same view that the market has. The market has this idea that there's still 2 to 3 rate cuts to come at the end of this year. We can see that through survey data and even in bond yields. But we also have to understand that there are other levers that the Federal Open Markets Committee, or the Fed, that they use to control economic policy and basically guide the trajectory of growth. So the concern right now, obviously, is that, okay, if the Fed sees that growth is on track and, hey, look, we may not even need to decrease interest rates, that opens up the possibilities of, oh, okay, is there even going to be a rate cut to come? Are some of the other measures that the Fed are undertaking going to even loosen up? And one of the other things that we can watch too is the Federal Reserve balance sheet. Now, what you really need to know about this is the Federal Reserve itself can go into the open markets, like the bond market in the US, and basically look to provide liquidity or provide cash into the system by buying these bonds and holding it on their own balance sheet. Now, what we've seen is, all you need to take away from this chart, if it looks complicated, is that when we do see it rise, they're increasing the amount of liabilities on that balance sheet. They're basically waiting for all these bonds to mature over years and years. So that's what we saw during that period when obviously everything was quite frothy in the markets. And we saw crypto run a very heated bull market, metaverse, NFTs, everything was going crazy, as well as broader stock markets as well. But since 2022, since that inflation cool down or crisis, if you want to call it, when we saw interest rates rise, we've seen this balance sheet run off very steadily. And the key thing is here that, again, in this meeting, again, they haven't changed their tune. They're looking to run this balance sheet down. So this is what's referred to quite commonly as quantitative tightening. And this is a term that many have heard, but you may have heard we either have two regimes, quantitative tightening or quantitative easing, and that's called QE. So QE and QT can look like many different things. One of them is interest rates, so setting the price of money. And then we can also look to what is the actual Federal Reserve in this case, or even the governments themselves. What are they doing to, again, bolster and support the economy, inject money in so everything can grow, so banks can lend out more money, companies can go out and grow and build out product lines or become more productive, etc. Right? So again, we've seen nothing but a downturn trend in this particular graphic. And again, we're not seeing interest rates ease either. So that's where like the everyday investor who's got this idea of, okay, we're expecting number one, this to either potentially slow down or pause, some sort of re-injection potentially just to try and help stimulate the economy, or we're waiting on interest rates to basically come down further. And when we look at even the likes of poly markets, which is basically a predictions market that's open to everyone, we've seen since this recent news from the Fed that the market's doubling down on their expectations. They're actually saying, hey, look, we're actually expecting that no change to really fall off a cliff here because really, how long can they keep this up? And the market's just doubling down on this whole idea. And this is when we're trying to obviously approach the coming weeks. Are we going to see the bull market continue? Really, the question we should maybe be asking ourselves, is the Fed going to be, or the policymakers, is there going to be alignment between the policymakers and what the market's thinking? Or are we going to be dealt some sort of surprise where one of those two are caught off guard? And that's what we're not sure of. Obviously, if the market's caught off guard, we could see a potential sell-off as they cool down their expectations of these cuts coming or just easing of monetary conditions, a shift into QE. Or is the Fed wrong? Has the Fed cooked their expectations? That's the other way to look at it. And when we look at what is the Fed actually looking at, number one, they're looking at inflation. And what we have next week is inflation data coming out at the middle of the week. And in his most recent speech, Jerome Powell did say they will be looking for a material softening in inflation. Again, they do use pretty loose language or very broad stroke language when they talk about these things. There was nothing prescriptive. There wasn't any targets or any percentages. So again, it was something that they'll take into consideration. And again, when the market receives that inflation data next week, we don't know what it's going to be. That's going to, again, change the market's perspective on, okay, what will the Fed think if now we know that inflation's gone higher or lower, which again, we'll know next week. The other thing we can look at is growth data, which again, we can look at metrics like GDP Now, which is a forecasting tool from the Atlanta Fed. This looks to take all of the current data and put it through a mathematical model and basically provide a more real-time snapshot of how growth is looking. And right now, the expectations are for growth to continue and not really waver. So again, if you're a policymaker and you're not seeing growth slow down, or the other things we can look at, jobs slowing down, there's not really any incentive based upon what we heard last week for them to come to the party and basically give the market what it's expecting, which is those rate cuts. So again, that's another piece of the puzzle that we as investors and people thinking about how the market's going to move want to take into account. And that's where it all gets really interesting too, because we can also look at what's the market's expectations of inflation heading into next week. And this is where the trend has been quite categorically down. Now, this is an ETF called RINF. It's a product that basically dictates what's the market's expectations of inflation moves in the near term. And this is important. It's about near-term trends. So we can see during April when we saw the tariff war really kick up, the market expected inflation to materially rise into the back end of May. And since then, we haven't seen really expectations really shoot up any higher. In fact, since the middle of July, we've just seen this particular ETF move to new relative multi-month lows. So that kind of tells us the market itself has its expectations set that inflation isn't going higher. So again, when we put all these pieces together, it's about understanding what's the market thinking, what's the Fed thinking, and then when the data lands, obviously we'll have the full scope of what's likely going to be the outcome. Someone's going to be caught offside here, be it the policymaker or be it the market. And I think that's what's the most interesting thing right now heading into towards the end of August, into September, when all of this data comes into the next key meeting, which is about circa 40 days away. Within 40 days, we would have received enough information for the policymakers to now make their next move. And again, we can see quite categorically, the market is thinking rate cuts, right? So it's about understanding between now and September 30, does growth slow down? Does it speed up? Does inflation slow down or speed up? Does employment data speed up or slow down? And that's really going to shift and change everyone's expectations. And hopefully by that stage, as we get closer to that September 30 mark and we see all these data come through, it's a very easy game to try and understand of who's going to be potentially caught offside as all the different data points land heading into September 30. So I hope that wasn't too overwhelming. I think it's very important now, especially as we head into Q3, which is known to be a quiet quarter, historically speaking. What's at play here? There's a lot of people that may be coming back into the crypto space after seeing some of the elaborate moves that we've seen in altcoins, and also Bitcoin just touching new all-time highs only about 3 weeks ago. If you're trying to wonder what's the global macro environment looking and how's that going to inflect on crypto, essentially at the end of the day, if there's confidence in the market to show growth, that has been quite good for crypto and Bitcoin and altcoins in the past. So we look to see if this is going to be the case again. But thanks very much for sticking around this long. If you made it, if you have any questions, shoot them in the chat. You can catch me on social media as well, on Twitter. Be happy to have a chat around some of these topics. And I think the most interesting thing is once you get a small idea of how this all comes together and you see the data prints land yourself, you'll see how the market reacts, right? And you'll have a better understanding of, okay, this is actually what we know now, as opposed to right now was guessing ahead what's going to be coming in September. But that's it from me. Catch you again next week. Cheers.